one in the trading space in YouTube tells you exactly what you should do, and they don't tell you what you should stop doing. This video will be different from those kind of videos. I will exactly dictate what you should look for in the markets and what you should completely skip looking for in the markets. Okay. So I chose this time to speak about liquidity exclusively because I myself took an entry in the live markets. I'll just show you. Okay, so uh, I took that entry on the date of 2nd December, and I'm recording this video at 4th December. So here, this is the entry. This is the entry that I took, and this revolves around using liquidity concepts. So I'll just mark this, and I'll be explaining how I took this entry. But before this, you should learn the fundamentals. Okay, so we will be back here within a second. I have made a small presentation. This time we are not going to Canva, we will be in TradingView. Also, if you guys haven't seen my previous video, if you're a beginner, I suggest you watch the video, because if you don't know that, this won't be making any sense to you. Okay, I should give a disclaimer first. A must to know before you trade SMC. So guys, let's say all you know is market structure. Okay, so you have no idea about order blocks, you have no idea about inducement, liquidity. So if you ask me, can I trade smart money using just the market structure concepts? The answer is a big no, because these 4 topics are primary pillars of SMC, and they go hand in hand in the market. So don't try to trade SMC just by knowing a single concept. And if you ask me a question like, okay, I'm not really planning to learn SMC, but I know market structure concepts very well. Can I make money just by knowing market structure in the markets? The answer is a big yes, and that's what I recommend, guys. Just learn a simple concept, master it, develop your own strategy, backtest it, have a good amount of data, optimize your strategy, and you will easily get better results. If you think that learning all these concepts and mastering them, putting it together and backtesting, it's a big work. I'm not going to lie, but I would recommend always go for the strategy. You personally, you kind of have the same frequency with the strategy. So that's what makes you a profitable trader, not learning more. Okay. So like I said, we will be looking at, just a second, we'll be looking at liquidity for this particular video. I can't go into detail about for just in few minutes, but when you're done with this video, you'll exactly know what you should look for in the markets. So there are 2 types of liquidity in the market, and you should know that these 2 types are not only exclusive for smart money concepts. These are global topics. It doesn't matter which market you trade, which time frame you use. It doesn't even matter which strategy you use. These 2 topics will be useful for all of those things. So these are the specifics, but I'll be telling which you should look for and which you should stop looking for in all these things. But before that, the $1,000,000 question is, what the hell does liquidity actually mean? What is liquidity? Liquidity, this, that, all these things, all these, you hear the word liquidity like 100 times every day, and there are 1,000 lakhs of videos. But liquidity simply means whatever you see in the market, everything is liquidity. So let's take order blocks. There are thousands of order blocks. Let's say fair value gaps. There are thousands of fair value gaps in the market, right? So that's it, guys. Everything is liquidity in the market. So don't really complicate this concept. So let's go to the specifics. we will be looking at static liquidity, and it means anything in the past. Okay, so the market is right here. You can see the market is right here. I'm using replay button, as you can see, and let's say this point is A. This order block that I mark here is point B, and let's say the high here is point C. Okay, so the only reason the market from point A moves from point A to point B instead of going from point A to point C is because point B has the most liquidity compared to point C. That's the simple truth. Don't complicate this more. That's it. Don't think Goldman Sachs, BlackRock, they are hunting your stop losses. Don't think China is handling your stop losses. Okay, it's simple concept. The market always moves where there is higher liquidity. That's it. Okay, that's why I'm saying when market comes to your order block, to mitigate your order block, the only reason is there is some liquidity in the order block, more liquidity compared to this high. That's the simple concept. Don't really worry about all these things in the back. I will we are not discussing market structure. This is just for understanding the basics and fundamentals of liquidity. Okay, now what you should look for in the market, I would simply say avoid looking at static liquidity in the market completely, except for order blocks. Okay, so as you can see, I have marked an extreme order block here. Just look at the structure. Okay, don't look, don't look behind, just look here. Okay, so I have marked an order block, an extreme order block here, and I will mark a fair value gap here. This is not really a fair value gap, guys. So I know many people take this as a fair value gap. It's not a fair value gap. I take a fair value gap even in a smaller size. It should be like wait, I will show you. You see here. Okay, you see here. I sometimes take this as a fair value gap and I take an entry here. I completely don't consider fair value gaps at all. Okay, all I consider are order blocks. I only take entry from order blocks. I completely ignore fair value gaps, but just to explain, I take this tiny space as fair value gap, and even this is a fair value gap. Okay, but it's completely useless. I don't use fair value gaps, and I don't recommend you guys to use fair value gaps at all. So you should understand the probability of a trade winning and giving a higher return is more when you take an entry in order block than if you take an entry in fair value gaps. If your strategy revolves around fair value gap, that's okay. If you have data back tested, that's okay. But I recommend always take an entry from an order block. Don't go for fair value gaps. Don't go for imbalances. I completely avoid using imbalances because there's no use in using imbalance, right? What's an imbalance first of all? Yeah, as you can see here. Okay, let's take this entire structure. People call this imbalance. Okay, where will you take an entry here? If you take an entry and put your stop loss here, if you look at the stop loss, about 40 pips. If you're adding 40 pips stop loss in Euro USD, then you won't be getting good returns, right? It's probably a swing entry more than a SMC entry. So guys, looking for imbalance in the market is completely useless. Don't do that. Always look for order blocks. Don't look for fair value gaps. Don't look for imbalances. Okay, completely useless topics. Now let's go to double top and triple top. Okay, I will just give a good example. First of all, yeah, this is not really a double top, guys, because point A and the next other portion is point B, right? Point A happens first, point B happens second. But as you can see, point B sweeps above point A, it takes all the liquidity here. So it's not really a double top for me, but I would suggest it doesn't matter. Don't look for double tops or double bottoms in the market. So let's go. Yeah, there's a good example, a beautiful example of a double bottom here. So as you can see, point A is here, the other portion is point B, and it hasn't swept the liquidity below point A, right? So there's liquidity below this double bottom. Okay, so what's the use of finding this double bottom? How can you even incorporate this in your trading strategy? The simple answer is you can't. So simply stop looking for this. So I will just drag this double bottom all the way from where the market takes the liquidity below this structure. There's liquidity below. Okay, I will drag this. Okay, as you can see, this is the place where market sweeps the liquidity below this double bottom. But how can you even incorporate this in your strategy? Where will you be taking the entry, right? I mean, I know that the trend might have changed. As you can see, the trend might have changed, all those things. But the reason why you should stop looking for all these double bottom, triple bottom, all these things is you can't incorporate them in your strategies, right? So even after taking the sweeping the liquidity below this double bottom, it just gave a tiny, tiny pullback. How can you even take entry in this, right? So completely useless. Don't look for double bottom and double tops. And if you are so persistent that you will look for them anyway, I suggest look for double bottom or triple bottom or double top or triple top in the higher time frames. I'll just at least look for them in 1 hour. Okay, it might have a good reaction in 1 hour. Other than that, don't look for these two. The only thing you should look for are blocks. Just remember that. That's enough. Now let's come to trendline liquidity. It's the same, guys. Even if you find them, you won't be able to incorporate them in your strategy. So it's completely useless. Let's look at an example. Okay, so this is a good example. I'll just remove this. So there is a small trend line here. There is obviously liquidity here. Like I said, everything in the market is liquidity. Okay, obviously there is some liquidity below this trend line. So the issue is, how will you incorporate this in your strategy? Will you be taking your entry here? For example, will you be marking it like this, and will you be taking an entry here? No, this it doesn't work like this, guys. Okay, you should always, like I said, always remember, it doesn't matter how good of a liquidity structure you mark. Your entry should always be in an order block, nowhere else. Your stop loss should be in accordance with your order block. Your take profit should be in accordance with your order block. Okay, so that's the reason I'm saying don't look for these trend line liquidities and all these things. Completely useless. I mean, there will be a time where you should look for all these things in this side. Okay, in this side you should be looking at all these things, but that comes entirely under the concept of live liquidity. So we won't be naming them as double top, triple top, all those things. Okay, what the hell? I'll just okay, we will do that at the end. Okay, so Asian day, week, high and low, guys, the same answer. You won't be able to incorporate this in your strategy. This, if you think that this will be used for finding bias in the market, you're completely wrong. Just use market structure to find bias in the market. Don't use all these things. Okay, I completely don't use these things to take entries or something. I don't even look at them. Okay, all I look are order blocks, and like I said, few higher time frame, double bottom, triple tops, all those things. So that's it, guys. Just stop looking for all this static liquidity which is in the left side of the market, anything in the past. Now let's go to the juicy part of this video. Let me just okay. Okay, so that's that. Let's go to the live liquidity concepts. Anything in the present is called a live liquidity, which means anything that forms in the right side of the market. The market accumulates liquidity using minor structures and uses it to move up or down. That's it. It's so simple. So I will explain using this tiny diagram here. So like I said, this line separates the left half of the structure to the right half of the structure. This structure that's forming in the right half is called live structure. It's forming right before your eyes, right? So that's called live liquidity, and anything that happens here is live. Okay, keep it as that. So like I said, the only thing you should use from static liquidity is order blocks. So order block is here when the market, and also this green line is 50% fib level. I never take an entry in the premium zone. Always I take an entry in the discount zone. So let's say the market comes from here and here to here, and instead of tapping on this order block right away, the market does all sorts of things here, right? It moves like this, sometimes it comes like this, sometimes it just goes hog wild in the right side of the market. If you're wondering what this is, it's simple. This is what I'm talking about as live liquidity. Anything that happens at the present market accumulates liquidity in order to go up or down. And the reason is very simple. Now we are an uptrend, as you can see. Okay, so the market accumulates all this liquidity both on the top of this accumulation and bottom of this accumulation. And what it does is it sweeps this liquidity that it accumulated just now. It mitigates this order block, and only then it gives us a proper break of structure to the upside. Now, how can you use this, right? That's the bigger question. It's very simple. Of course, there could be fair value gaps here. There could be tons of fair value gaps, order blocks here, but guys, that doesn't really matter. Okay, we usually take entries from two order blocks, one order block in the middle, one order block in the end. We call this extreme order block. We call this the 50% order block. So market does only one of three things: takes this, goes up, takes this, goes up, breaks, gives us a breakout structure, or else it breaks this structure and it changes trend from bullish to bearish. But we will not be looking at that. We always trade pro trend. Okay, we never trade counter trend. So that's why it's useless discussing what happens if it breaks. You taken loss. That's it. There's no other way you can escape from this. You should always take either one of these two entries, and if the market plans to break this structure below and turn bearish, you should take that stop loss SL. Okay, it's nothing wrong. That's how market works. Let's talk about just the extreme order block right here. So you can use this when the market comes here, when it starts accumulating like this. It can be like this, or it can be like this also. So like I said, we will be using the trendline liquidity in this side, right? This is what I mean. So the market accumulates a trendline liquidity here, and then in order to mitigate this order block, it just sweeps all this liquidity, and then it mitigates this order block, and then it breaks the high. So you should stay away when the market is accumulating. Completely stay away from the market. It doesn't matter if this is 4 or 5 minutes. It doesn't matter which time frame this is. when the market is accumulating liquidity, just stay away from taking an entry. Okay, so that is that, guys. It's very simple. If this, I don't think this is really hard. Okay, when you look at the markets for quite some time, you will easily be able to find out when the market is actively accumulating liquidity. Now let's see the reason why it's doing that. Let's say, let's speak like a video game. Let's say the power of this order block is 60, and let's say the power of this high right here is 100. So what does the market need in order to break this high? Let's say the market is retracing. So I mean, if you ask the question, how will I know if this is the high? You need to learn inducement concepts, and you don't have to worry. I will be posting about inducement concepts where you can validate if this is a proper high. So like I said, let's just look at liquidity in this concept in this video. So the price comes here, right? In order to break this high, it needs a total power of at least 101. So this order block has 60. The power, the fuel, this order block has a 60. So what the market knows already is this order block will be insufficient to break this high, to follow the trend, right? The market is going bullish, and in order to follow the trend, the liquidity in the order block is less. So what it does is it starts accumulating live liquidity. This is where you should know what the market is doing. So when you see the market is forming live liquidity here, one of two things is going to happen. Market will sweep the liquidity from the upside, go tap this order block, give us a proper breakout structure. Like I said, we are not discussing trend change. That doesn't matter. That's irrelevant. Okay, just pro trend. It can sweep upside, come down, take this, and then it can go up. So we can assume that the power level in this accumulation is 40. Okay, so 40 plus let's say 50. 50 plus 60 is 110. So the market gains a very strong liquidity, and then it now can break this high. So that's how accumulation works, guys. So the other scenario is it can sweep down, and then it can break this high. Okay, so at both of these times, you should know when to stay away from the market. Don't get caught when the market is trying to accumulate. It will hunt your stop loss. This is what most people refer to as institutions. Goldman Sachs, the Chase Bank, it hunted their stop loss, right? This is what they're talking about. So I will explain using my entry. So if you want to take a screenshot of this, I'll just go to my entry that I took. Okay, so let me use the replay button here. Well, it's kind of messy, right? So I'll delete all these things. Oh, yeah, now I can see something. Okay, so this is London session, and like I said, this happened on 2nd of December. So what the market does here is it taps on some extreme order block in the left side here, and then it goes up. But as you can see, I have marked a minor breakout structure here. So I'm looking forward to take entry in this order block. I'll be placing my stop sometimes like this, sometimes I put it like this. So let's say I put it like this. Okay, about 130 points. So you can see the market goes up and it knows that this order block is not sufficient to break this low. So what does the market do now? It accumulates liquidity here. What I said, it sweeps this liquidity and it tags us in. It tags us in, and then as you can see, it gives a breakout structure. Usually I take only 2:1, but it gave a very good also. So guys, if you want to name this liquidity accumulation, let's say you want to call this double bottom, triple top, I mean that's completely useless, right? Just call this entire structure as a live liquidity. The market is accumulating liquidity, that's it. And also, if you remember, I said this happens only at the right side of the market. So this is the left side, this is the high, this is the low that needs to be broken. Okay, this is the low that needs to be broken. And as you can see, everything that happens in the right side is nothing but live liquidity that the market accumulates. You can see that the interesting thing you can see here is the market even fails the order block that I took entry from. And if the reason is inducement, I will be going through inducement in another topic. So that's it, guys. It's very simple. Don't complicate this too much. Let's look at another example. I might have taken an entry here. Okay, that's not it. Okay. Yeah, even this is a good example of accumulation. As you can see, I took an entry here and I got my stop loss hit. I'll just remove this. There's an order block here, right? What does the market do? The market accumulates liquidity here. It accumulates liquidity here. It breaks the liquidity. It taps in an order block and then it breaks this high. The same concept over and over again. Live liquidity always works. So this is what you should look for, guys. If you want to call this as a trendline liquidity, it's completely okay by me. But it's kind of a completely absurd thing to do, right? Because the market can do anything here. It can do like this. It can go subtle. It can do whatever it wants. All you need to know is it will sweep the liquidity and it will mitigate your order block. That's for sure. So guys, that's why you should stop looking at all those static liquidity concepts. Those are all very fabricated, very filtered out. They have filtered out the true essence of SMC. That's a very sad thing, but at least now you know. Don't look for all these things. Always look for order blocks. Look one and only for live liquidity in the market. Use this live liquidity to take a proper entry in an order block. So that's everything about liquidity, guys. And it was very simple, right? It's not really that complex. Don't complicate these things. Just keep it simple. When you just practice these while you backtest and while you see live markets, you will get the hang of it very soon. So I hope this was of some help, and if you have any doubts regarding trading, be it any doubt, your strategies, markets, time frames, if you have any doubts, I'll be happy to answer. And if the question is really good, I will even make a separate video. So guys, that's it. I wish you success in trading, and most importantly, I wish you guys peace. See you.